Good morning, hunters, and welcome back to the Daily Hunt for Multi-Baggers. It's Wednesday, November 5th, 2025, and we're digging into the data collected yesterday, November 4th, for some fascinating market insights.
That's right, Ethan. Today, we've got quite a few names popping up in the discussions, but what's really striking is the intensity. While there's a lot of chatter, our AI-generated insights are flagging a generally high-risk sentiment, especially around valuation, even for companies showing strong growth.
Indeed, it feels like the market's weighing some serious future potential against some very stretched present-day numbers. We've got a lot to unpack, so let's dive right in.
First up, we're looking at Toast Inc., TOST. The user sentiment around this one is pretty bullish, Ethan. Folks are really enthusiastic about its full-stack restaurant operating system and its market position.
Yeah, Brooke, it sounds like people are seeing TOST as a real weapon built for restaurants, eating everyone's lunch with its comprehensive ecosystem. They're talking about strong competitive advantages, moving up market, and expanding globally. Even a significant deal with Uber. That's a lot of growth drivers.
It is a lot, but let's tap the brakes for a second. While that revenue growth is strong at nearly 25%, the KPIs tell a story of extreme valuation. We're looking at a price-to-earnings ratio of over 91 and a price-to-book ratio of 11. That's a huge premium. And the net profit margin is still quite thin at just over 4%. It's like the market is already pricing in all that future growth before it fully materializes.
I hear ya. But the Uber partnership, Q3 exceeding estimates, these are real catalysts. Couldn't these events really accelerate that margin expansion and eventually justify the valuation? It's about capturing market share now.
Potentially, Ethan, but the current metrics scream caution. Given that this stock has never been rated before on our podcast, our AI-generated insight for Toast right now is a stay away. The valuation is just too aggressive for new money, even with the growth narrative.
Okay, fair enough. Next, we have Joby Aviation Inc., Joby. We've discussed Joby before, classifying it as a stay away back on October 29th. Today, we're seeing some really aggressive bullish sentiment from some users, with calls comparing it to the next GameStop and a generational play. They're hyping it up for potential earnings YOLO plays.
YOLO, indeed. That extreme bullishness from some parts of the community is unhinged from the reality of its current financials. Our AI-generated insights show a negative revenue growth of over 46%, an EPS of negative $1.07, and an operating margin of nearly negative 1,100%. This company is deeply unprofitable and burning through cash.
But Brooke, what about the new NVIDIA partnership and FAA-certified production, accelerating commercial launch prospects? These aren't small developments. The autonomous aircraft market is taking off, and Joby is a pioneer. That's the long-term vision fueling this optimism. Surely these will impact future KPIs significantly.
The news is promising for future potential, absolutely. But future potential doesn't pay the bills today, and it certainly doesn't justify a price-to-book ratio of almost 14 for a company that isn't making money. The high debt-to-equity of 4.474 and a beta of 2.52 just add layers of risk to this speculative analysis. The data suggests it's still very much in a capital-intensive development phase, not a profitable one. So our AI-generated insight for Joby remains a stay away.
All right, moving on to Strategy Inc., MSTR. We last flagged MSTR as a stay away on October 31st, downgrading it from a speculative gamble earlier in October. User sentiment today is mixed, with a slight leaning toward bearishness, largely revolving around the drop in Bitcoin's price.
And the market commentary is spot on. Bitcoin just broke below 100,000, which directly validates the bearish put option bet we saw discussed. MSTR's financials are highly correlated to Bitcoin, and its exceptionally high debt-to-equity ratio of over 14 is a massive red flag. Its return on assets is negative, meaning its primary assets aren't generating returns.
But for those who believe in Bitcoin long-term, MSTR is a leveraged play. The company introducing a euro-denominated preferred stock stream could be seen as a way to continue their strategy and buy at lower prices, anticipating a rebound. That shows conviction, right?
It shows conviction, but also increasing leverage and risk. A beta of 3.374 means any downward movement in Bitcoin is significantly amplified for MSTR. Given Bitcoin's recent drop and broader market liquidity concerns, the short to medium-term outlook for MSTR's valuation and profitability is challenging. Our AI-generated insight for MSTR remains a stay away. The risks are just too substantial right now.
Next up, Advanced Micro Devices Inc., AMD. This is a name we've consistently rated as a stay away for some time, with one brief cautious buy interlude back in mid-October. User sentiment today is overwhelmingly bearish, despite AMD beating Q3 estimates and giving strong Q4 guidance. People are just disappointed the stock dipped.
And for good reason, Ethan. The market commentary suggests the good news was already priced in after an insane run-up. Our AI-generated insights confirm an extremely high price-to-earnings of over 150. Coupled with a negative operating margin, meaning the company is actually losing money from its core operations, that PE is simply unsustainable.
But AMD is a leader in AI chips. The demand is incredibly strong, and they've shown excellent revenue growth of nearly 32%. That Q4 guidance was very optimistic, signaling robust future performance. Shouldn't that growth eventually correct the operating margin and justify a higher valuation?
It could in time, but eventually isn't now. The market is reacting to a valuation that is simply too lofty for current profitability metrics. Investors who bought earlier are taking profits because the upside from the news was already baked in. For those looking to enter, the risk of a significant correction is too high when the stock is this close to its 52-week high, despite the strong revenue. Therefore, our AI-generated insight for AMD remains a stay away.
Finally, we're looking at Reddit Inc., RDD. We've often rated this as a stay away or speculative gamble. Today, user sentiment is generally negative due to recent losses, with comments lamenting that the stock kept dipping even after smashed earnings multiple times.
That's a critical disconnect, Ethan. While the company boasts incredible revenue growth of almost 68% and a healthy net profit margin of 18%, its price-to-earnings ratio is still sky high at over 86. The market seems to be struggling to reconcile that strong growth with an appropriate valuation, as evidenced by the stock experiencing a significant plummet around the time of these discussions.
But Deutsche Bank just maintained a buy rating and even increased their price target to $255. And we're seeing news about a profitability milestone and high growth forecasts. Doesn't that indicate underlying strength that could propel the stock much higher once the market settles?
Those are indeed bullish signals for the company, and they certainly have the potential to improve future KPIs. However, the high PE implies much of that potential growth is already priced in. The historical volatility, including that recent sharp drop, shows that even good news might not translate to sustained stock appreciation if market expectations are too high. For now, the high valuation and past price action signal significant risk. So our AI-generated insight for RDD is a stay away.
All right, Brooke, let's round up today's list for our listeners. It seems like the market's still chewing on a lot of growth stories with hefty price tags.
It truly is. Today's analysis has highlighted several compelling narratives, but very few clear entry points based on our AI-generated insights and KPI analysis.
Investigate as buy. None. Investigate as cautious buy. None. Investigate as speculative gamble. Joby Aviation. JOB.
And that wraps up another episode of The Daily Hunt for Multibaggers.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Absolutely. Thanks for tuning in, and we'll catch you next time for more market commentary.